Well, hello, everybody. We are still having quite a few folks log in. We're actually at 395 attendees. So if you happen to know 5 people that might want to join this webinar, go ahead and let them know so we can break that 400 match. But we'll get started here in about 60 seconds. Just allow some more folks to join it, which means we're going to sit here awkwardly and stare and not touch anything so our marketing people don't freak out about it. So what am I talking about? Look, this will be recorded, so you guys don't have to wait. It's going to be fun. I see, my good buddy Brian Gilpin hopping on here, Brett Taylor. I can see the bees obviously here. So I think we're getting to a critical mass here. So why don't I go ahead and begin by welcoming everybody in attendance, and good morning to you if you're out here on the West Coast, or good afternoon if you're in other parts of the country zooming in here. My name is Chris Anderson. I'm the Chief Administrative Officer of Mortgage Capital Trading. For anybody, and if you didn't know, that's abbreviated MCT clearly here. If you didn't know where I worked, I think I got it on a water bottle back here too. But if you're not familiar with MCT, we're a capital markets technology firm that focuses on delivering, absolute best-in-class service paired with the best-in-class technology. And we have an ecosystem of over 350 clients, and those clients can be publicly or privately held. They could be independent mortgage banks, depositories, credit unions, aggregators, and we're in that privileged position of having great relationships with those clients, and those great relationships actually transcend into building great relationships with our mutual clients, other vendors, such as the panelists that you see before you here, and that I'll be introducing shortly. That position really allows us to get in front of not only our mutual client base, but the industry as a whole with what we feel is really timely and important information. So we really want to, on behalf of MCT, but on behalf of all of the panelists, and you can't see Nicole right now because she's traveling, but I'll be introducing Nicole too. But on behalf of everybody, thank you so much for joining us here today. We're happy to have you. So David and Danielle are supporting us in the background from marketing. So David, I'll ask if you wouldn't mind just moving us over to the agenda. So I'll start by just going through some housekeeping ideas, everybody, or housekeeping items, I should say. So the format of this webinar, rather than just sticking to that old, I'm going to ask 5 questions of each of the panelists, and you're going to hear similar answers from all of them. What we've asked each of the panelists to do is to speak on one topic for about 5 minutes. Then I'll open it up for questions from the rest of the panel. And speaking of questions, you can use your GoToWebinar tool. I think it's usually in the upper right side or lower right side of your screen to submit questions. I'll try to keep my eye on those questions, and I'll bring them up. Hey, if they're really good, I'm going to pretend they're mine. If not, I'll acknowledge you. But if they're good, I'm taking them for myself. So don't hold that against me. And keep your eye on those, but we are planning on giving you some time at the end for Q&A. If there are any questions that we don't have time to get to, our marketing team, again, David and Danielle, thanks so much for your help. We'll capture all of those. We'll circulate them to the panel, and we'll make sure that your questions get answered. And of course, this webinar is going to be recorded. It'll be circulated to all of the webinar attendees, as well as I think it'll probably be available on MCT's website. And importantly, all of the contact information for myself and all of the panelists will be included there. So as you can see, the agenda is pretty straightforward. Ben is going to be taking us through sort of what changed in warehouse lending over the last couple of years. Ann is going to walk us through how to sort of effectively manage relationships in this challenging market. Nicole is going to be working with us on sort of how to evaluate warehouse lender counterparty risk for both new and current lines, and some strategies there. I'm going to talk briefly about just coordinating with your hedge advisory firm to make sure warehouse lenders are in step with their clients and their hedge advisor on mark-to-market reporting and other reporting. And then Kevin's going to bring it home here. Kevin, we're leaving it all to you to give us why everything's rosy and great and 2024 is going to be amazing, and we're all thrilled. So no pressure, but if you can lower rates and increase volume in the next 45 minutes, that would be great too. So let me go ahead and start by introducing this amazing panel. As you see up here on the screen, unfortunately, Nicole is traveling and not able to log on by video, but Nicole Avey is VP of Warehouse Lending with Western Alliance Bank. And Nicole, thank you so much for joining. So we'll be hearing but not seeing from Nicole shortly. We've got Ben Bowden and Nicole, I'll ask you to introduce, tell us a little bit about yourself. When I'll ask each of the panelists to tell us a little bit about yourselves, a little bit about your background when I introduce your session, if that works for everybody. And we've got, thanks, Nicole. And we've got Ben Bowden, who is a VP of Relationship Management and Warehouse Lending for First Horizon Bank. Ann Stedman, who I think I met at my very first conference maybe 12 years ago. Ann, thank you for being so welcoming to me. And a shout out to our good friend Rhonda Beck, where she's living in retirement right now, gosh darn. But Ann is a VP Warehouse Lending from Customers Bank. And Kevin, who we put all the pressure on here to tell us how everything's going to be fine, is President of Warehouse Lending over at Wintrust Mortgage. So we just want to give you a little bit of background about why we put this together. So last year, look, we saw, regional banking crisis. We saw pressure on originators. A ton of MCT's clients have gone through really tough financial times. There's no beating around the bush. Q4 is most likely not looking super pretty for too many folks, and that is capping off a kind of dire year. So, there's as well as, some lack of confidence maybe in certain areas of the warehouse lending space as well. We had originally intended to have this conference or this panel at our conference in March, our MCT Client Exchange Conference. But instead, the panelists and their respective firms all agreed to kind of work with me and MCT to move this much more forward and have it here in February. We put these guys on the spot to do this pretty quickly, but we thought the information was really timely and wanted to get it into not only our mutual clients' hand, but also take, the ability to kind of address the industry as a whole and really kind of fulfill that advocacy for the industry that MCT and Customers Bank and First Horizon and Western Alliance and Wintrust all kind of hold dear to us. So I want to thank the panel for doing that very well. And I do also just want to let all of my other warehouse lenders buddies know who are complaining to me that I didn't invite them. I know and love all of you guys. I know they're wonderful, but I really do want to just thank again all of the panelists and their respective firms for being supporters of not only the MCT Client Exchange Conference, but being willing to come here and work with MCT to address the industry as a whole. So thank you. And I have been talking way too much. So David, let's jump into the next slide here, and let's hear a little bit from my good friend Ben Bowden. And Ben, tell us a little bit about yourself and give us an idea about what's changed in warehouse lending and what you're seeing.
Well, thanks, Chris. I guess you're making the new guys group go first, huh? Yeah, so again, Ben Bowden, First Horizon. I currently work with roughly 40 independent mortgage bankers across the U.S. I always joke with people that there's 10 of us at First Horizon who support our customer base, and we're not territoried. So I always joke with people, say that I have customers from Rhode Island to Hawaii. Thinking about, I guess, to the question of what's changed over the last couple years, I'll kind of summarize it in two areas, and I think the first one is just the way that we're communicating with all of our customers has changed significantly. And I think if you think back over the last couple years, just rewinding to the end of 2021, we were seeing a lot of mortgage banks had scaled to levels that they maybe previously had never been before because they had been taking advantage of one of the top refinance booms that the industry had seen. But then by early 2022, we started to see that market conditions were starting to change rapidly. I personally kind of think about it within our group. The leadership of our group had pulled all of us together in January of 2022 and just had told us that they were starting to see signs that the market was likely going to change rapidly, and they'd actually been discussing this with our credit folks for months and kind of starting to talk about how we were going to respond to a market coming off an all-time high and kind of what they thought was going to happen. Frankly, I remember seeing that meeting and thinking, hey, we're riding high right now. Things are booming. What are you talking about? But I think by March of 2022, that kind of came to roost, and so really conversations started to evolve. So in March of 2022, it was like, I was saying to our customers, hey, it's starting to look like the market's changing rapidly. Are you seeing it, and what are you doing? Then by the third quarter of that year, we were asking questions of, hey, the market has changed. What are you doing to address the decrease in revenue that you're seeing? I think by the third quarter of 2022, we were starting to see two camps. There were some companies that said, hey, we're going to continue to try to drive revenue, grow revenue to be able to stay profitable. And then there was a second camp that was starting to say, hey, we're starting to look at expense control and margin control just because we see revenue, decreasing significantly. Fast forward that to the first part of 2023, Q1, a lot of the communication, we started to do a lot of communications to really clearly understand the specific changes that mortgage companies were making and had made and how they were manufacturing their loans and the costs associated with that. Because by the first quarter of 2023, as we were starting to get 2022 year-end financials, we were clearly seeing that there were a lot of mortgage companies out there that had posted losses, and some had posted very significant losses. So, as we got into the back half of 2023, the conversation evolved again to say, hey, we're continuing to bounce along the bottom here. Frankly, what are you doing to stay in business? I think about it, I guess from a specific standpoint, there's a couple things. And, as companies had started to post losses or had, scaled back because of a lack of revenue, we're starting to see people inch towards, busting covenants or, even when they're posting losses. I know there's a lot of warehouse banks out there that will have a profitability covenant. And so obviously, if you're posting losses, you're having covenant issues. I think we were kind of lucky because First Horizon doesn't have a profitability covenant, so we kind of understand the historic seasonality and cyclical nature of the business. But we were having very direct conversations with our customers to really truly understand what they're doing, how they're managing their operations to a lower revenue environment. I think about it. This isn't the first time that we've seen that. If you rewind as quickly or as far back as 2018, we saw customers lose money in 2018. But this time it seems like it's been a little bit different because by 2023, I think we're seeing systematic deterioration in the market, and it was becoming and has become an existential threat to mortgage companies. So we're keyed in on things like pro forma projections, burn rates, and even break-even analysis. Really, were a lot of the conversations that we've been having here over the last 2 years. I think, Chris, I'll kind of summarize it, from a tactical perspective. I know from a webinar standpoint, a lot of times it's good to see, hey, what are specific things? I think that there's really three things that I've seen us do at First Horizon over the last 2 years. And again, the first one is we've gotten very detailed in our conversation surrounding mortgage company back offices and their secondary marketing. Really, we want to know what they're doing to stay profitable, and frankly, we want to know what they're doing to stay in business. We've also gone through and right-sized our lines, again, coming off of a boom time. We try to set our lines to make sure that our customers, can keep them half full on a monthly basis, on an average basis. That gives them the power that they need if the market does change quickly or they do a bump. But also, I think it also helps to make sure that that mortgage companies aren't over leveraged. And then I think the final thing that we're doing is focusing on how we're structuring our lines. So I think specific to First Horizon, we structure our warehouse facilities on a committed, uncommitted basis. As we began to see volatility in the space, and we've seen the mortgage market in general lose a lot of warehouse capacity in the last year. We've seen banks exit the space, and we've seen others that have changed their parameters. And so what we have done is work on a customer-by-customer basis to address the committed portion of those lines. I think what we hope that does is that gives the mortgage companies that we work with peace of mind, and also continues to show our First Horizon's commitment to the warehouse space and to this lending space in a very uncertain market. So I think mainly it's been a lot of detailed conversation and really trying to understand what everybody's done to reposition their companies in an ongoing market downturn.
So that's great, Ben. And, I think from MCT's standpoint, we've been having a lot of those same customers, and whether it's from folks, unfortunately having to exit the space, or maybe they're merging with other customers, consolidating with other customers being acquired, those are certainly conversations that we're all having more, so that the takeaways that I tried to capture there and hopefully did was, you're communicating more deeply about even the back office operations, really understanding how your clients are managing their budgets. Frankly, we're not all just printing money like we used to, right? Also, adjusting their capacity of their lines it sounds like an important part, and then restructuring lines, looking at that committed versus non-committed production. And so all of that sounds lockstep with, kind of some of the concerns that brought MCT into really wanting to huddle this panel up, which is, we see folks struggle with their broker-dealer counterparties or mandatory investors. If they go silent, if they're not out there proactively working, and if they're not responding to the financial realities of the world, that can make their counterparties concerned. And so I love this ability that you're working with clients one-on-one to delve in there. And Ann or Nicole or Kevin, would any of you guys like to jump in and add anything to that?
No, I think I have mine pretty much covered in my next segment, my segment. So, yeah.
Well,
I completely agree with Ben. Getting in front of the, your clients so that you've got the right utilization levels, that allows you to not have, any non-use fee. I mean, clients don't want to pay non-use fees, so right-sizing lines midstream makes sense. And I couldn't agree more that given what's going on in the industry, it certainly makes sense to only have committed facilities. It's just so darn difficult. And as an IMB, do everything you can to get in front of, any profitability covenants or things like that. And we share the same, as Ben does, and not having them, because they truly are make work covenants that they certainly don't help any of the parties. I mean, the key covenants we all know. It's liquidity, leverage, net worth. But
that's great, Kevin. Thank you. And Nicole, I know it's tough not seeing you, but I will tell everybody that you look amazing. I'm positive. Did you want to add anything?
Of course.
To that?
The one thing I would say that maybe is moving the other direction is, what's changed is that there was a big focus on deposits. I know you're going to hear it probably from every one of us as we go through the call today. But at least from our side, we're seeing that that's normalized from a year ago, and that there's a bit more flexibility about that, and that, I think all the warehouse providers are looking, to work with our partners. We understand everyone wants a piece of that pie of deposits, and I see that as a good thing, that there's a lot, again, just a more normalized environment. It's not going away, but it's more flexible.
That's awesome, and great point there. And I think generally from a macro perspective, one of the things I see is that, I'm not getting calls from somebody that I talked to one day and they're out of business the next. I think a lot of the folks that maybe hadn't been as well prepared have unfortunately had to exit the space, and the folks that are remaining have done a much better job working with all of their counterparties, right, as well as working with their teams to scale back to the right size. No company is immune to it. MCT has had to do the same thing and strategically realign our workforce to our workload in different areas, and I know a lot of us have done the same thing. So, David, if I could ask you to go ahead and advance to the next slide. I think there's going to be some common themes here. We're already touching on them, Ann, but Ann's going to walk us through and tell us a little bit about yourself, Ann, and walk us through how to effectively manage, your warehouse relationships in this darn market.
Okay. Sounds good. I'm the Vice President of Warehouse Lending for Customers Bank. I cover all the South and Southeast for warehousing. I've been in the business, I hate to tell you this, for over 35 years in the mortgage banking industry. And so enjoyed every minute of it. And, warehousing is just a piece that I totally love, and love working with the clients and love working with our bank. Our bank is, the banks are awesome. All of the credit facilities that we have on our event today is all great partners, and we all deeply appreciate each other. And I want to say, Chris, thank you very much for allowing us to be part of your event today. So with saying that, as far as communications goes, pick up the phone. Communication's the key. to having a great working relationship with your warehouse provider. It's just like Ben said, we all had challenging years. The challenging year for 2023 for IBM and warehouse providers due to companies closing, being acquired, warehouse providers exiting, and companies having losses. To help your relationship manager help you manage your credit facility, please don't wait till the last minute to notify us of something that's going bad. If you're going to have breaches or things of that sort, we want to know ahead of time. And if we know that ahead of time, we definitely are willing to work with you. And I think I speak for all of the companies that are here today, but if the communication is the key to a great working relationship.
And I find that when I'm going to be late home for dinner, I call my wife well ahead and warn her. I don't just show up late. Is that what you're getting at there?
I would think so, yes.
I just manage expectations very low. Keep going,
yeah,
Anna.
That's right. That is perfectly okay. Have your financials in on time. I think all of the warehouse providers today is keeping a close eye on that, especially, with what's going on in today's market. If you do not send them in a timely manner, where it's monthly or quarterly, this is going to cause you to be out of compliance. And if you do have breaches, this will cause you to have a cross default. So by staying in contact with your providers is the key to a successful partnership and to a relationship with your warehouse provider, because if we know ahead of time, then we can talk with you and work with you to get our credit risk people more comfortable with about what's going on in your business. If you think that you're going to have a net worth covenant breach, liquidity, funding, leverage breach, and you know that you're going to make some major management changes in your company, that's going to be another reason to notify us ahead of time. Please send an email with your financials when they come in on a monthly or quarterly basis if there's losses on there. And what is your plan to put the company back to profitability? And I know that Ben touched on this and so did Kevin, some of the things that we look at is that what is your monthly cash burn? What measures have you taken to cut cost? Net income for the next 3 to 6 months. What's your projections for the next 3 to 6 months? What's your break-even point? And when do you think that you will have the company back into profitability again? You will need to discuss if you need to discuss having the covenants reduced, you'll also need to seek approval from all of your credit providers that you do business with. You'll find out if you notify them ahead of time, again, they're going to be willing to work with you through anything that your company is going through. Again, notification is very important to the relationship and to a warehouse provider. And this shows that you've got a good partner. So that's what makes good relationships out here in the industry for both parties. So.
And that's wonderful. And I know I am getting a little sentimental here, but hearkening back to our friend Rhonda Beck, who's retired, one of the things she taught me was, look at MCT, again, I have to say this or my boss will kill me, best technology in the world, but it's these relationships that drive. And I remember the very first time I got my hand slapped from talking to one of Rhonda's clients, despite maybe being a little higher up in the organization. But I have learned my lesson. And working with folks, building these relationships with folks like yourself and Nicole and Ben and Kevin, where you guys are passionate about maintaining these relationships. And just look, AI is going to take over everything. Let's be human with one another. And I think, MCT is committed culturally to doing that. And I know your organizations are as well. Look, we all have fiduciary responsibilities at the end of the day. But would Ben or Nicole, Kevin, would you guys like to jump in here? Just wave at me if you would like to add on. I think we're going to hear some common themes here. Go for it, Kev.
Yeah, Ann's exactly right. Getting in front of this with your, with your warehouse lenders is such an asset for you, and it allows us to put the best spin on any request to adjust covenants or modify TNW levels, liquidity levels, things like that. So just better communication helps just so much, and it really allows us to speak on your behalf to our credit folks. We can get things done for you. Ann's right on the money with that.
Yeah, and there's I apologize. I missed from my good friend Phil Kakofka here. Phil, thank you. For some reason, my question line is about this big, so I can't totally make it out here, but I believe the question is are you guys adding additional, adding additional covenants with renewed lines? And that's all I can see. Marketing, if you can see more. But does that question make sense to you guys? Anybody want to hop on that one? Or Phil, shoot me an email and I'll track it down if I didn't get the question right there.
That's the full question.
Chris, I'm happy to jump in on that one.
Go for it, Ben, please.
Go ahead, Ben.
Yeah. So we're not adding covenants, but I think, on a customer by customer basis, we're looking at covenants. So, I think a lot of times when business is good and everybody's booming and making money, I think they're always critical, but they're not necessarily top of mind. But I think given that we've been bouncing along the bottom now for so long, a lot of companies have deteriorated. So covenants are becoming a more common conversation. I think, the answer is I don't see our bank adding new covenants per se, but we are looking to make sure that they are set right. Are they set in a way where a company can still be successful? Are they set in a way to where a company's going to make, will a company materially change or deteriorate significantly before the bell goes off and we can get involved? So I think they're looking at it, but adding new covenants, no, I have not seen that.
No, I don't think that we'll be, that's not something that we're looking at right now. But one thing for sure is that, by them notifying us ahead of time where we can work with them on those type of things, it strengthens the partnership basically and the relationship there. So, we're not looking to add anything, but what we do is that when we do bring a new client on board, we try to mirror what they have with their other credit facilities, because again, if you don't and you breach one of these, you're going to have a cross default. And that's something that we don't want them to have. We want to make sure that we're all in sync pretty much.
And Nicole, did I hear that you might have something to add on that? I apologize if I missed that.
That's all right. I'm just trying to take my cues from listening. So I would echo what Ben was saying, with just the approach is not punitive. We are seeking to understand what the performance is and modify the covenant to where they're reasonable and something that, I would say the goal is that it mutually makes sense. But, our goal isn't to have to touch these every single quarter as well. If we can give ourselves a little runway and have them set where they're reasonable, but we're still talking, I think that goal is the same. And I do think, in most every case, we're all looking at the same end game, which is positive. And the other thing I just wanted to add under the broader conversation of managing, through the current environment is these institutions, we do loans across a lot of segments. So if you have loans that are aging on the line and things that are a little different from just general covenants, sit and talk with us. We do this for a living as part of our business. We have a trade desk. There are things that we would look to offer you to help across the warehouse line in addition to just challenges with covenants.
Thank you very much, Nicole. And Nicole, perfect timing. Unless anybody else has anything to add, why don't we shift on over to Nicole, David, if you don't mind advancing that next slide. And Nicole, if you wanted to share a little bit about yourself and just, what you think would be best for folks to do when they're evaluating warehouse lender counterparty risk for either new lines and current lines. And if I could ask you, there's a Actually, I'm getting a great question right now. I'll come back to you on it. But why don't you tell us a little bit about yourself and go through your prepared comments, and then I've got a good one teed up for you.
All right, I'm ready. Nicole Levy, VP of Warehouse Lending Sales at Western Alliance. I've been with this bank since 2021. And my background is 20 years of correspondent lending and due diligence, and got my start as a CPA with Deloitte & Touche. So that's certainly been valuable in this role and great experience. And my topic, just looking at evaluating counterparty risk. We've talked about a lot of these things that, there's going to be a lot of recurring things that you all are going to hear. The deposits is one that I would just reiterate. Any new relationship existing, we are looking for some deposit relationship. That's a core requirement. It has normalized, and again, seeking to be flexible, but also have it be meaningful as we're looking to extend credits. And the second we've talked about is it's great if you have operating profit on a month-over-month basis. If you don't, a similar theme of we are looking to understand, have you made those tough decisions where you're at or near your break-even production on a monthly basis? We understand where things are at right now, and we're just really looking for that baseline. And if you have a good structure in place to step up into profitability when things turn in a different direction. The other that we haven't talked about maybe as much is we are getting requests not only for renewals, but also with extending new credits for some what I would call higher risk sublimits or extended dwell sublimits. I think everyone's, we're creative in this market, and we are looking to find things that have reasonable margin and that we can execute on. If you are asking for those things, I would encourage you to be ready to talk about your experience in originating those assets, your experience in underwriting the assets. Who are your takeout options? Do you have more than one? And we obviously would probably have some experience with most of those, and that's going to play a part in that decision. And then depending on how much of a carve-out you want for some of those things, we may be talking with you. If you don't have a personal guarantee on the line right now, maybe there's a limited personal guarantee or restricted cash, just things that might get us more comfortable and get you what you need and move us forward. But those are just some of the discussions that we've been having with our credit partners here, and we almost always are able to find a solution that's mutually agreeable. I would also echo, not sure who was talking about this, but just the conversation of utilization. Capital is still at a premium. We are committed to continue deploying capital in this space, but we do want to deploy it with partners who find broader value in it than just a sublimit or 2 or 3% utilization on a month-over-month basis. We're looking for that, just a focus on being a partner that has a reasonable wallet share, again, as we move forward, because there's a lot of people who are looking for that capital. The last piece we kind of talked about when we did our prep work was around what are some of the things if I'm coming and asking for credit or renewal that maybe I should be thinking about that give me leverage with the warehouse provider. And just the things that we talked about here are where can you add additional value to the bank? Not only does it give you lift with your potential warehouse approval, but exceptions and other things that may require some flexibility as we move forward. So we happen to have the luxury of having a correspondent partner. We have a trade desk that can help with scratch and dent. We have a great commercial card program. Clearly, business banking is a specialty of ours, and all those things I would encourage people to look at. MSR financing, lockbox, have those discussions if it makes sense for your group and it's a fit. It does give you more touch points in the bank, and I think that's, Ann talked about this, the relationship is a big focus right now.
Yeah, that makes
I'll catch my breath.
Oh, Nicole, that was wonderful, and we're starting to get some great questions here. So I'm gonna kick out a couple of them But, just a couple takeaways that I heard there that, capital is still at that premium. So utilizing capital is important, but also utilizing different lines of service at the bank can also be just as important, right? And build leverage for your relationship. So I think that makes total sense. I'll kick it if Ben or Kevin or Ann, do you guys have anything you're dying to jump in there on? If not, I'll pose a question to all of you if that would be all right. Oh, go ahead, Kevin. Sorry.
One thing that I'd say is be creative. If you're an IMB, be creative. Think of wealth management services, things like that you could bring to the bank as well as just plain deposits. There's so much value that we as lenders can share with our credit folks and others. As we say, it's a complete relationship with the bank. So just really try to think outside of just the plain box of just deposits, just loans to other services that you can bring.
And Kevin is an excellent chef as well. So if you private chef services, he can put those in. I do some bartending on the side. We can all get in there, guys. We do some stuff.
Yep.
But one of the things that really rang true to me, Nicole, that I love to hear was, look, we're all, in the risk management business in one way or another here, was this idea of having multiple outlets for new origination. There's a rush to originate any new product out there because we're all struggling for volume, or all of our clients are struggling for volume, understandably, but having that tried and true experience originating, underwriting, as well as the ability to sell those assets to different outlets is great. So a couple good questions just came in. Harry Wong, thank you so much. As we talk about evaluating counterparty risk, what are the warehouse lenders' views on actually, a client doing due diligence or being reviewed by a client? What sort of information are you guys able to provide, and are you generally agreeable to, to that practice? I know I certainly have to go through it a million times over. My hair used to not be gray before I did all that due diligence work. But Ann, you want to start us off on that?
Well, as far as due diligence is concerned, when we bring on a new client, and I'm sure that Kevin and Ben, Nicole, they all do this as well, as we get a third party audit basically performed on the client. That also gives us comfort there as well.
And how about the client turning it back on you? What's available to the client to do, to get that?
We're a publicly traded bank. So
Sure.
They could actually go out there and check us on New York Stock Exchange. Our symbol is QB, C-U-B-I. So they definitely could go out there and talk to, but get information from the exchange. And the call reports. They can also check the call reports. And then word of mouth is the biggest thing. Networking and asking some of their other friends out there in the IMB world, who they're using, and, what banks have got flexibility. Are they relationship driven? Some of them are not going to have the best price, but you might be able to get these sublimits that you're looking for, out there by doing that. So.
Sorry, Ann. Ben or Kevin, anything to add to that? I mean, if a client were to ask you for, I know I prepare these due diligence packages,
yes.
And I have a wonderful team that helps me with it, thank goodness. But, sometimes I get a questionnaire with 800 questions on it, right? They only want it in 24 hours usually, but what do you guys provide from the client side?
Well,
or if the client requests information?
Chris, it's pretty straightforward for us. Obviously, just like Ann, Wintrust is publicly traded. We're a $56 billion bank. So, obviously all the financial information they can get. But we always, anyone who asks, well, we certainly have clients, that they can call, and talk with directly, and talk with any and all of our operations folks who are, frankly, they're really terrific. And I always share a story. There's a club that's always on the table, and either the warehouse lender has it or the independent mortgage banker has it. And if you're in a relationship, no one's going to pick it up and just beat the other over the head with it. And that's how we are. When it's in our favor and we could take advantage of the situation, when somebody needs a desperate increase, we're there for them and we're not going to take advantage of them. And it's the same way. A good relationship, that client's long term, and they're not going to rough us up. And that's what you want. So anyone from a counterparty that's looking should be able to talk to any of our clients that we could certainly give them names and references on to see how we've behaved in the past, and if they feel that we'd be a good partner.
Ben, same from your side. Go ahead, sir.
Yeah, I'll come at it, more from a, as the relationship manager, as the, the guy trying to win that business. A couple things that I would throw out there for people to evaluate a warehouse bank is to look at, systems. How do you fund a loan and get those wires out? Other things to look at is how is the funding and post-closing relationship managed? Is it are there, do you have a specific, team at the bank that directly works with you? Then you look at things, price always comes into play, but then are there other ancillary fees? I think, Kevin had mentioned it earlier about, not some banks will charge a non-usage fee. Some people charge application fees. So there's other points that are just then beyond just interest rate itself, but then, and then I think really just the final thing goes back to the track record is, how long have they been in the space? I look at, one of the first things I'll point out is it's been over 25 years. I mean, that, you can go back to that's pre-08. So we've been through that cycle. We've been through the cycles before. And so, I think that demonstrates not only the competency, but even just the bank's commitment to that space as you ride the cyclical nature. So I think, those are some other things to look at specific from a warehouse and how they operate and some things that can be different from bank to bank.
Great. And Nicole, you want to wrap up with any thoughts there? We're getting a lot of great questions, so I think we're going to hustle through my next session. But Nicole, what else would you add?
I would say two things. What not only to do is only look at stock. We're talking about those of us that are publicly traded. Understand the dynamics and the metrics that are core to the institutions, right? I think we just talked about it when we got on. There are a lot of very solid banking partners on the phone and not on the phone today that are committed to this business, that have good core metrics, conservative, and manage their business as well. Look at the ratios. Learn with CET ratio, things that you can track, and as part of that, I would pay attention in the earnings calls to anything they're talking about for a lot of commercial risk or things like that. Again, I do think that this group and that the warehouse providers are very stable as a rule, and so I think that the environment, again, is much different than last year. And outside of that, I also would ask, in addition, I think Ben was talking about this, the support. Is the support group in the office? Are you having someone that's picking up the phone? Are you getting things resolved? And ask for those referrals, those questions. It makes a difference in your experience. That's it.
100% agree with all of that. And, I think, again, a lot of the reasons why so many of us, kind of collaborate together, because I think we have those same philosophies of building those relationships. Even though if AI is listening, I'll be the first to sell out all my human being friends and be a slave to AI. It's coming, I'm sure, but let's hope not too soon. So, look, why don't I jump into the next slide here? And just in the interest of time, because I'm getting some great general questions here from different audience members. So, David, do you mind just advancing the slide? And I will kind of go through this quickly. And look, really what I just want to convey to everybody is that whether you're using MCT or you're using any other hedge advisory firm in the space, there's a lot of great companies out there. We've got, a lot of great folks in this industry. One of the things that I have found really helpful is if a client asks me to sit down and meet with their warehouse lender or do a call, or I've done this on the fly with warehouse lender staff who may not be familiar with MCT's reports versus some of the other folks in the space. We are willing to take the time to walk our clients with their warehouse lenders, through our reports so they can get a good understanding of really what the metrics that we're measuring, what we're benchmarking to, any questions that might be there in general. So that's kind of just a quick one. I think everybody agrees with that. So I just say make sure that for clients out there, utilize whether it's MCT or whoever your hedge advisory firm is to help you in this communication with your warehouse providers. And so since we've got about 15 minutes left and I think we've got some good questions here, I'll go ahead and table that and I'll turn it over to Kevin and ask Kevin here to just walk us through, David, if you don't mind advancing. Kevin, remember, no pressure. You're here to tell us everything that's going to be rosy and great. Rates will be down momentarily, but what are you seeing? What are your expectations? What's Wintrust planning for? I know you guys are all committed to this space, but talk to us a little bit about what you're seeing upcoming, sir.
Sure. Thank you, Chris. And frankly, thank you for the opportunity to the other folks at MCT for putting this webinar on today. You know, we've certainly seen that not only is MCT a resource for the mortgage community, but also for warehouse lenders like ourselves. We've seen how they've been able to help out our clients manage difficult situations and frankly emerge more successful. So, you know, a little bit about myself. I've been with Wintrust for a little bit over, for approximately 25 years, been in banking about 33 years. I love the mortgage space and the reason for it is really it attracts the best entrepreneurs. It certainly has some of the most creative, dedicated, folks, and they're survivors. You know, a little bit on Wintrust, we've been in the warehouse lending space for, again, about 28 years, but we were a small little niche, you know, that worked with smaller IMBs, and we just market ourselves under, you know, our community bank name, Hinsdale Bank and Trust. And over the years, we've just expanded now, you know, nationally under Wintrust. And I understand that today it's a really difficult environment frankly, for both independent mortgage bankers and the banks that provide the credit in this space. My primary message would just be take advantage of the dislocation that's happening in this industry. Obviously, Wintrust took advantage of it. I couldn't believe when Comerica made the decision to exit warehouse lending. They had been in it since '65. They were just incredibly well respected and a really tough competitor of ours. So obviously the minute I heard that they were exiting the space, I wanted them to all join our group. I mean, we're extremely bullish on the industry. You know, Wintrust, we take advantage of dislocations and market disruptions when they happen, and we like to grow niche businesses. So, you know, we're obviously very fortunate that group joined us in November, and, you know, I feel really blessed. You know, when I talk with independent mortgage bankers, and one of our customers, I'll steal part of his story, you know, that there's trauma the industry has gone through, and you've got three choices. You can flee, freeze, or fight. Well, the ones that want to flee, they've already left. The ones that decided to freeze, they'll be gone soon. They aren't already. And the ones that are going to survive are fighting. And you have to, you know, the obvious ones are obviously cutting expenses, taking advantage of other opportunities, expanding product offerings that you do. But also, and most importantly, from our perspective, think about how you're viewed when a regulator comes in and takes a look at one of the files. And I early in my career, when I had a great relationship with one of the regulators, it's very obvious that they like things simple. You know, if you lost $3 million in the fourth quarter and you've got $11 million in cash, well, obviously you're going to be out of business a year from now. I mean, there's nothing else in the file that's going to tell an auditor or an examiner something different. So how are you presenting yourself, not just to your warehouse lender, but to their credit committee? And why it matters on the regulators is risk ratings. So when you get put into, you, an independent mortgage banker, get put into a worse risk rating category, all the required metrics change. And there's management pressure and a lot more difficulty. So help us help you be successful. And that's showing a pathway to success. We've, you know, and be creative in your thought process. You know, we've seen folks where guarantors, well, frankly, we've seen folks that didn't used to have a guarantee. The boom years happened, became non-recourse, and they're like, you know, why don't we make it recourse? Because pricing's more important to me than my guarantee. You know, think of other solutions that can be creative. And that's really a real takeaway, because, you know, we're in a tough environment for, again, for the IMBs and also for banks, given where interest rates are. And so you can be successful and work your way through it, but just be creative and be very, very upfront. I believe that a year from now, it'll be a materially improved market. I think that rates are going to be heading in the right direction, and it's just going to take some time. But we'll really see that as we get to towards the fourth quarter, and it's just hard to get through it. People get blinded by what just happened the past 3 quarters and just project that on forever. But again, myself, certainly, Ann, and and the rest of the folks that are on this call, we're bullish on the industry. So it's just our objective is to really help you have the best light that you could possibly be in when others look at you. So I think it will get better, but it's just a tough environment that we've just got to fight through, and we can do it. We can all do it together.
What did I tell you guys? We can all do it together. Help us help you. I told you this guy's good. He brought it home for us here. So the other thing Kevin has that, it always bothers me is that he's taller than me. But what's wonderful is he's at every conference and you can always see him. So he towers. I think I come up to about here on him. So you can always track Kevin down. And Ann or Ben, Nicole, what would you like to add to that outlook for 2024?
I totally agree with Kevin, is that, help us and then and we'll help you as much as we possibly can. And I think that from the overall view of the market is that with us being on the line, we're here for the long haul. And our banks are committed to this program. And we will be here for the IMBs for sure. So
thank you, Ann. That's awesome. Nicole, it sounded like you wanted to jump in there.
Yep.
I just wanted to end on a positive note and say, if it's encouraging, we've had our first waves of groups that had right-sized their lines so much they needed to increase, right? So we have some bold requests that have come through, like, you're celebrating, like, yes, this is what we've been waiting for. And we're writing new business. We're extending new credit. And so there are good things happening, and people, I believe, are starting to look out and see that they want to be positioned when it turns around. And I think all those are good signs.
That's awesome, Nicole. Agree completely. Ben, how about you, sir?
Yeah, I guess my couple parting thoughts. One, just to echo what Nicole just said, is we are writing new business as well, and a lot of that new business is focused on where you're going. I think going back to our conversation earlier about projecting out pro formas, just kind of we've been starting to look for that. There's multiple levels of sophistication on this call from an independent mortgage bank standpoint. I'm sure from large to small, but being able to understand where you're going, where you're trying to go, has been extremely important on our end to be able to write that new business. I think the final point that I'll just say, Chris, is going back to even, I think, why all 4 of us are in our banks are in this space is because I think we all do have a fundamental belief in the need for independent mortgage banks in the mortgage marketplace, and that I think we believe and our banks believe that that IMBs will continue to see market share growing within the space in the coming years, and so we're positioning ourselves to be able to support that.
That's awesome, Ben. And I'm not going to let you guys go just yet because, remarkably, we have 5 minutes left. And I know with this brain trust, we can answer some good questions. So I see a couple here. First, and whoever feels strongly, you just yell out first, and I'll go to you. But non-QM products, and I have this conversation with folks quite a bit. MCT has the largest outsourced lock desk service in the country. So while it's not traditionally hedged production, we hear about it on the lock desk side. what are your guys' feelings about non-QM loans, and specifically, are you allowing a certain segment of non-QM, and then, you know, what do you require from the lender, and does it matter, you know, who their takeout is ultimately, or anybody feel strongly about that? Want to jump in?
I'm happy to jump in.
Nicole and
okay, did I get the first prize?
You got it.
I just will reiterate what we were talking about on the sublimit conversation. Yes, we absolutely are offering non-QM sublimits, and there are tranches of that are very common, and we also have a trade desk, so we could share with you who are the most common takeouts and share some trending with you, and where is the product performing. There are some riskier, I think, subsets that some folks have looked at, and that's where those conversations come in about what is your experience. Have you been originating a lot of the kind of more common non-QM products, and is this an add-on to what you're doing, and just understanding how many takeouts you have and your experience with them, and layering on our experience with those takeouts as well.
Thanks, Nicole. And I see a lot of nodding heads, so I'm going to try to answer more questions here, guys. I'm going to go for it unless somebody's really adamant about it. This, I think, is a quick one. Cash burn. So somebody, let's see, Michael Dunnigan, and I want to thank Stephen Gildia for that last question. Michael Dunnigan writes, can you specifically define further cash burn analysis that your credit uses? Specifically, does that just mean, does cash just mean cash on balance sheet, or perhaps include cash equivalents and cash liquidity available to them via other lines of credits, MSR, et cetera? Any quick response on that? Go for it, Ben, and then Kevin will follow up.
Yeah, I think I had talked about burn rate a little bit. I personally look at it from two ways. I'm looking at monthly burn, just even from both cash and liquidity. I view, there's cash, but then we look at liquidity more as like a quick ratio. We're looking at, how many, in a current environment, how many months, how many quarters do you have left? Kind of what Kevin was saying earlier. If you just look at the numbers, it can be very simple, although normally the answer is not that simple. But, we're looking at it monthly, quarterly, and we're looking at both cash as well as just more of like a quick ratio from a liquidity standpoint.
Kevin, anything to add to that?
Yeah, you look at it, you've got to look at it each way. So again, help your lender so that we can deal with pushback from auditors and regulators. So they're going to choose the easiest way if you don't give them anything else. You need to always stay at least 12 months. If you've got a cash burn and a regulator, auditor, examiner comes in and says it's less than 12 months, they're going to want to criticize and downgrade that client, unless if you've got something that you can push back with. So obviously we want to use everything that's possible, cash equivalents, other things. So just help us so that we can reflect a more positive environment. These were one-time losses.
Help you.
Amen.
So we've got a little less than 2 minutes here. I'm going to grab one more question here. Something that's real, that I think has been a little topical in the past. Are there any concerns with warehouse lenders doing MSR financing on their Ginnie Mae loans? Are you guys seeing any concerns with that from an industry perspective?
No.
Nicole?
No, that's common. As long as they're within the guidelines of Ginnie Mae, we are absolutely engaged in that space.
Ben, Kevin, Ann, anything to add there?
We offer MSR financing as well, but we will not sign the Ginnie Mae acknowledgement. But we will look at other alternatives for doing an MSR facility for them on that.
Okay. Ben or Kevin, sounds good. And then just a real quick one. How will Basel III affect warehouse lending? That should take 30 seconds. Go. I'm kidding. So look, we've got some great other questions coming up here. I'll circulate those questions to the panel. We want to be respectful of everybody's time. David, if you wouldn't mind just flipping that slide forward. Everybody's contact information is here. You can screenshot this, or this will be circulated to everybody. I want to thank, on behalf of these wonderful panelists and their firms, thank you for your support of MCT, for our mutual mortgage lenders, the industry as a whole, and thank you to this wonderful audience for showing up. We had a great time. That is a good one, guys. Let's do it.
Yeah.
All right,
Thank
everybody.
you.
Thank
Thanks,
you. Have
Bob.
a great day.
Bye.
Thank you.